Welcome to this explainer on Chapter 7, Project Appraisal Under Risk. Think of us as your expert digital tutor for ACCA Financial Management Syllabus Area D3. We're going to build your ultimate financial toolkit for navigating project risk. Because, let's be real, making investment decisions isn't just about looking at those rosy best-case projections, right? It's really about understanding exactly what happens when things inevitably don't go according to plan. So let's just dive right in and break down how we actually adjust for risk and uncertainty, turning all these complex theories into clear, actionable strategies. Here's our roadmap for today. Number 1, risk versus uncertainty. Number 2, sensitivity analysis. Number 3, probability and expected values. And finally, number 4, alternative risk techniques. All right, Section 1, risk versus uncertainty. Let's define the unknown. You know, people use these terms interchangeably all the time. But in finance, they are entirely different beasts. Risk is kind of like playing roulette. You know the exact odds. You can actually assign quantifiable probabilities to specific outcomes based on past data. Saying something like, okay, there's a 20% chance our sales drop next quarter. Uncertainty, on the other hand, is like playing a game where you don't even know the rules. It represents unquantifiable futures. Think sudden global pandemics or massive, disruptive new tech. You simply can't put a reliable percentage on uncertainty. So our toolkit today is built specifically to handle the first one, quantifiable risk. Moving right along to Section 2, sensitivity analysis. Let's start testing some variables. So the crucial point here is really understanding your margin of safety, like exactly how far can a single metric slip before a project becomes essentially worthless. And when I say worthless, what I mean is the net present value, the NPV, hits exactly 0. Because at an NPV of 0, remember, the project is only just barely covering its cost of capital. Sensitivity analysis is fantastic for this because it isolates just one specific variable at a time. It asks a very blunt, direct question: how wrong can our estimates be before this investment just completely turns into a bad idea? Okay, so here's the exact 3-step process you need to pressure test your project. First up, you have to isolate a single variable. Never do multiple at once, okay? Just one. Step 2, calculate the percentage change required. To do this, you just take the NPV of the whole project, divide it by the present value of the specific variable you're testing, and then multiply by 100. That final percentage is your ultimate threshold, which leads us to Step 3. Say your sensitivity is 5%. Well, a 5% drop means your NPV goes negative, and boom, the project sinks. The beauty of this is that you isolate just one moving part at a time. We're talking sales volume, selling price, variable costs, or maybe the discount rate. You do this to pinpoint the absolute exact threshold of failure. Imagine management is super confident in their fixed costs, right? But they're sweating about consumer demand. Well, by running a sensitivity analysis strictly on sales volume, you can literally walk into a board meeting and confidently say, look, we can afford a 10% drop in sales volume before we start losing money. It provides incredibly focused, practical boundaries for decision makers to actually monitor in the real world. All right, let's jump to Section 3, probability analysis and expected values. Time to crunch some numbers. The expected value formula is pretty straightforward. EV equals the sum of each possible outcome multiplied by its probability. So, EV equals the sum of X times P. Think about it this way. X is your cash flow outcome, say 50 grand or 100 grand. P is simply the chance of that happening, maybe 40% and 60% respectively. You literally just multiply each outcome by its probability, add them all up, and voila! You've got a weighted mathematical average of your project's long-term cash flows. Pretty neat, right? But wait, this brings us to a major trap that analysts fall into all the time. It really requires us to step back and ask a critical question about the real-world application of averages. This is honestly the Achilles heel of the expected value method. What if we only build this project once? As you can see, relying on expected values for a one-off project is just incredibly dangerous. Why? Because you can't repeat the event enough times to ever actually achieve that mathematical average. Think about tossing a coin, okay? The expected value of a 50-50 bet for, say, $0 or $100 is mathematically $50. But in reality, you're only ever going to walk away with 0 or 100. You literally never get the average. So if you're building a massive, one-of-a-kind, multi-million-dollar factory, it's either going to succeed or it's going to fail. Expected values are amazing for high-volume, repeated operations. Think like issuing car insurance policies. But for a single capital investment, it completely masks your downside risk. And that brings us to Section 4, alternative techniques. Let's look at some other risk methods. So if sensitivity and expected values just aren't cutting it, you have three alternative methods to really level up your analysis. First up is simulation modeling, often called the Monte Carlo simulation. This is where you use computer algorithms to change multiple variables at the exact same time. It generates thousands of possible outcomes to give you a true probability curve. It's super powerful. Second, we have adjusted payback. This one's simple. You just shorten the required time frame. If a project feels too risky, management might demand their money back in 3 years instead of 5. Makes sense, right? And finally, risk-adjusted discount rates. This is where you actually penalize risky projects by applying a higher discount rate. You're basically creating a much higher hurdle for the project's present value to clear before anyone signs off on it. So, we're going to wrap up this explainer by leaving you with a bit of a big question to ponder. Can any financial model ever truly predict unquantifiable futures, or are we always going to be just slightly at the mercy of the unknown? We've equipped you today with sensitivity analysis to find those crucial safety margins, expected values to weigh your probabilities, and some advanced techniques to tweak your parameters. But as we established right at the start, uncertainty doesn't play by the rules. The absolute best financial managers out there don't just blindly rely on these mathematical tools. They use them to build their intuition and guide their strategic judgment. So keep these concepts sharp, absolutely practice those formulas, and you are going to be incredibly well prepared for any project appraisal that ACCA throws your way. So, what do you think? Are models enough? Thanks so much for joining me today and keep exploring those numbers.